Hey guys, Taylor here, and this is not the next penny stock or get rich quick scheme. This is the Overlay Shares Large Cap Equity ETF. It's actually outperformed the S&P 500 since inception in 2019. And it's done so using an options overlay strategy involving a put spread. And the best part, at the beginning of this year, the fund managers announced that they were switching over to a 10 to 10.5% distribution rate. Historically, this fund just kept all the profits in the net asset value, but now it's going to be paying out similar to covered call funds, and it's already been doing this since the beginning of the year. And spoiler alert, it's outperforming there too. And while a lot of investors talk about this fund specifically, it also has two sister funds, the Overlay Shares Foreign Equity ETF, as well as a small cap ETF, which have both been producing similar results over the same timeline. So these funds have been through the pandemic, as well as Liberation Day, and have handled those with ease. So a lot of people were worried when they increased their distributions if that would cause the net asset value to fall. But over the past 6 months, we can actually see that OVL has a positive price return of about 4.61% versus the S&P 500's price return of 9%. Jumping into the total return basis, we can see that over the past 6 months, we're still outperforming at 10.2% versus the S&P 500's 9.74%. And as we saw before, since inception, we are outperforming by a significant margin, almost 20%, since all the way back to 2019. So now looking at the Overlay Shares Foreign Equity ETF, or OVF, this one actually seeks to outperform the MSCI ACWI US index through a combination of the capital appreciation and the options overlay. So we can see that over the past 6 months, we do not have any NAV decay. We've returned 6%. Looking at a total return, we can see that we have outperformed the ACWX index at least at 11.67%. And then on a total return basis over the past 4 years, we are lagging by a very small margin at 86.7% versus about 90.06%. And then looking at the small cap fund, we see that over the past 6 months on a price return basis, we have not had any NAV decay. We're actually up 13.7% versus the Vanguard small cap index, which tracks the same small cap S&P 600 TR index at 18.53%. I usually just use a lot of the Vanguard funds and VGT, so I'm most familiar with the Vanguard funds. We can see that on a total return basis over the past 6 months, we're again outperforming at 19.74% versus 18.53%. And then all the way back to 4 years ago, this one is actually outperforming like OVL at 75.11% versus 68.98%. So all three of these funds have done absolutely phenomenal over the past few years, even dating back to inception. So looking at the broader chart for just OVL in isolation, we can see that during the pandemic, we had a similar decline to the overall market. So we actually lost a little bit more because we are doing a put spread. So we will lose money anytime we put on a put spread and we go through those two strike prices. So if the fund decreases more than those, overlay shares or liquid strategies have said that the max on any spread that they put will be about 3%. But they have done a phenomenal job of capturing that upside and being judicious in, increased volatility, market conditions, so that they've been able to recapture a lot of that back on the upside. So I'm sure a lot of people that would be considering these are covered call investors and have other passive income investments and would be curious as to what percentage of this would be return of capital. And I'm pleased to say that looking at the 19A1 filings, 100% of the distributions since January for all three of these funds were actually return of capital. So these can be very, very tax efficient. Now that's not the exact final number. Sometimes at the year end, those change by a few percentages, but I would expect it to be very close to 100. Based on experiences with other similar funds like QQQI I've had in the past, they were pretty spot on. These definitely function different than covered calls. You do not have a capped upside, but then again, you can get hit harder on the downside if you hop on Seeking Alpha or Stock Analysis and start comparing these to covered call ETFs, you'll see that the downside is generally a little worse. So as always, this is not financial advice. I'm not a financial advisor. I'm just a guy on the internet. But me personally, I would strongly consider holding these funds in my portfolio just as a complement to some of the covered call funds. While the put spread strategy may underperform in a down market, I think the proof is in the pudding that they are outperforming in a strong bull market. So historically, the market is in a bull market 80% of the time, and historically, bull markets last significantly longer than bear markets. So I think these funds will continue to do very well and very likely outperform. So if you're thinking that everything's not going into World War III and the stock market's going to collapse, if the world keeps on business as usual, I think these could definitely outperform some of the covered call funds and even continue to outperform the index. I think they'd be a great complement to covered call funds. And I really enjoy the fact that these have been around since 2019. We can look at that pandemic data as well as Liberation Day data and see that, the bottom did not fall out of these funds. They were able to adapt their strategy and participate in a lot of the upside while minimizing the downside. So I hope this video helped. If you have any questions, leave them in the comments. I like to respond to all of them. If you enjoyed the video, hit that subscribe button, and I'll see you guys in the next one.